The ASX 200 fell 1.5% on Monday to its lowest level in 7 weeks, but that headline masks a split that matters more than the number itself. Energy stocks were the only sector that finished in the green, even as the rest of the market capitulated under the weight of Iran-driven oil prices. Brent crude pushed above $110 a barrel, extending an 8% surge from the prior week. The mechanism is not simply supply disruption, it is the Strait of Hormuz, through which roughly a fifth of the world's oil and gas normally flows, sitting effectively closed. Chinese vessels are being allowed passage through Iranian coordination, which means Beijing holds a lever over how quickly those flows normalize. U.S.-China talks in Beijing produced no significant announcement, and Washington's patience is visibly shortening. Trump posted Sunday that Iran's time is running out, and markets are pricing that language as escalation risk, not negotiation posture. Woodside and Santos each gained more than 2.6% as institutional energy longs absorbed the session's broad selling. Santos had an additional catalyst, first commercial oil from its Pikka project in Alaska, adding a production milestone that separates it from peers exposed purely to the geopolitical premium. Retail and passive selling flowed into cash rather than rotating into energy. The energy sector gains reflect institutional buying into a sector that benefits from the very risk that is punishing everything else. What makes that divergence hard to hold is this. At $110 oil, the inflation signal is no longer a sector story. Bond yields have already started to reflect it, and if yields sustain at current levels, the rate-sensitive sectors hit today face a second wave of pressure that the energy bid cannot offset. That bond yield implication hits domestic industrials through a more direct channel, and Brambles illustrated exactly how direct it can be. The company cut its underlying profit growth forecast from 8 to 11% down to 3 to 5%, blaming a US $60 million hit from pallet repair bottlenecks in its American subcontractor network. Shares fell as much as 16.6% intraday to a 12-month low of $18.38, wiping roughly $5 billion from Brambles' market capitalization. The announced US $400 million buyback did nothing to arrest the decline, which itself signals how severely the guidance cut reset institutional positioning. Active fund managers who held Brambles as a defensive industrial with visible earnings held the stock into the announcement. The magnitude of the sell-off reflects that those holders exited rather than averaged down. The mechanism behind the guidance cut is customer automation. Brambles' major clients are progressively automating their distribution networks, and automated handling systems require consistently higher pallet quality. Brambles is upgrading its repair standards, but that upgrade created a capacity bottleneck in April 2026, precisely when customer demand ran higher than expected. The result is a cost blowout that management expects to persist through the first half of fiscal 2027. The condition for recovery here is narrow. Repair capacity must normalize by end of the first half of fiscal 2027 as management projects. If subcontractor labor availability does not stabilize by then, the guidance range compresses further. The buyback provides a floor signal, but at a $29 billion company, US $400 million over 2 years absorbs only a fraction of what institutional sellers have moved to the sideline. Brambles' bottleneck is operational, but the Elders result reveals a structural cost trap that is harder to model and slower to exit. Elders shares fell 22% in a single session, erasing more than $340 million in market value. The trigger was an IT overhaul, whose cost has run well beyond initial estimates, compounding against rising fertilizer and diesel input costs hitting the farming clients Elders serves. The AFR framed it directly, a runaway bill for a crowd-based migration. That framing matters because it points to a different failure mode than the market usually prices into agribusiness. Elders lifted its half-year EBIT by 33%, which means the underlying business is generating earnings. The destruction was entirely in how the cost of a technology transition was absorbed. Capital fled the stock not because the farm sector is deteriorating, but because the IT cost trajectory had no visible ceiling when the result landed. The contrast with Pro Medicus, which gained 2.5% on the same day after announcing a $90 million cloud contract win, sharpens the signal. Investors moved out of Elders' cloud cost exposure and implicitly validated cloud delivery as a revenue model rather than a cost burden, provided the company is on the vendor side, not the buyer side. Pro Medicus operates a transaction-based cloud model. Elders absorbed a one-sided capital commitment. The same technology story, opposite capital flow direction. The question that session left unresolved is whether Elder's IT cost trajectory has peaked. Management did not provide a clear ceiling. If the cloud migration enters its final phase over the next 2 reporting periods, EBIT recovery on the underlying business becomes the dominant variable. If costs continue to run, the 22% decline today understates the repositioning ahead. The verification benchmark is the second half result. If migration costs stabilize below the EBIT growth rate, the stock finds a floor. If they don't, the gap between operational earnings strength and reported profit widens further, and institutional buyers will wait for the number, not the projection. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.